In this section, we'll continue our discussion on absolute valuation models. Earlier, we have introduced what absolute valuation models are. Under absolute valuation models, we discussed how dividend discount model works. Now we'll work on free cash flow models. Some of the concepts are similar to what we have discussed in dividend discount. E.G. The concept of terminal value. So what is absolute valuation model? It is to calculate intrinsic value of an asset. This is the reasons these are known as present value models, where we arrive at as a particular share price. If you remember our example of Microsoft, which was trading at the price of $29. So, with absolute models, which are dividend discount model and free cash flow, we will arrive at is a particular dollar value per share. Depending on the result, we will make a decision of buying or selling that stock. It could be $35 or $25 depending on the assumptions we made in the models. The bottom line is what you'll get at is a particular number. As compared to a relative valuation model, we will look at different kind of ratios, e.g. price to equity ratio, and then we decide whether a stock is undervalued or overvalued. Let us discuss basic concept of free cash flow. What does it mean? Free cash flow represents the money a company is able to generate through its revenue after subtracting the money required to maintain or expand its asset base. Free cash flow is of two types: free cash flow to the firm and free cash flow to the equity. Free cash flow to the firm is attributable to all the investors. In dividend discount model, we talked about dividends which belong to only equity holder and not debt holders, but here in free cash flow to the firm, we are talking about both investors. This is an important element, as with this concept we are looking at a company to pursue opportunities which would enhance the overall company's value. So in a dividend discount model, the value of the company will be determined by the dividend of a company, which is only the equity portion. It might not represent the full story. Looking at the third point, if the free cash flow is negative, there is a possibility that company is actually investing back their funds in the business. An example can be that our capex is much higher than the operating income. So, we are making huge investments. Basically, we are investing back in the company. Another way to look at is e.g. there is a growth rate of 5%, and in Asia e.g. the growth is 8%. If they thought of investing here after their due diligence, we can see that there is a negative cash flow at this level. After making investment to Asia, the potential of earning 8% or having a higher growth can create more value for that company. In a nutshell, we can say that a negative cash flow does not really mean that it's a bad news from a valuation standpoint. It could be positive. Maybe companies are investing in a particular product or a geography which can give us more return in long term, then this investment will make more sense. With respect to a firm's value, this formula represents firm value, which is free cash flow to the firm divided by 1 plus WACC raised to the power t. If we compare this with our dividend discount model, where we were discounting dividends, in that case we were discounting dividends and price, which is expected after 1 year, by cost of equity. So R represents cost of equity. In our current case, which is a free cash flow based model, we're discounting it by WACC, which is weighted average cost of capital between equity and debt holder. The reason is simple, as free cash flow is attributable to both equity as well as to debt holders. So that is why you need to use a combined cost of equity and cost of debt, which is a weighted average of overall cost of capital. This is an important concept because, as in reality, the funds can be raised in multiple ways. For example, if a company is generating 10% growth, and even if they have to pay 6% to the debt holders, or 6% of interest, there can be a value creation potential there for the equity holders as such. That's all for now. We will build on this model in our next discussions. Thanks and take care. Please share, subscribe, like, and comment.